My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. In March 2020, the world became almost surreal. In these last 30 years, I've never seen anything like it. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to researching the news and markets and providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity, this is CB3 Live. Good evening, everyone, and welcome. It's Thursday, live on March 18th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are here with us tonight. We are starting Season 2, and we could not be more excited about it. We've got a little bit of a new look here. I think you'll see a little different way to structure the material. Want to make it as clear as possible. If you were watching the video there and you saw the picture of me, on one side I say I'm a portfolio manager, on the other I'm a financial educator, but in the middle and most important, I'm an investor just like you. So that's our common thread. So the goals and dreams that you have for your family, I have the same ones for my family. I just also have the responsibility of providing the portfolio management for some of you and the education for all of you. So that's my goal, really, to provide peace of mind and financial clarity. And in line with that, I have something really cool to show you. I hope I can get this up on the camera right. This was sent by one of our special fans of the program, CB3 Live. And let me see if I can spin this around the right direction. I've got to do everything in reverse here. Excellence in clarity, okay? I can't promise that I can do that, but I can promise that I'm certainly going to aim for that. I think one of his favorite broadcasters used the phrase excellence in broadcasting. Well, we're going to shoot for excellence in clarity. And so for the question and answer section tonight, it's going to be different than Season 1. You guys can ask anything at any time. If you listened to the video, you heard 2 questions that I asked. How can I encourage you tonight? You have direct access to me for the next hour, and I'd like to answer those questions, and you can feel free to dialogue with each other as well. And how can I help you be more financially successful? That's really my goal. That's what I want to accomplish. So let's work on that together. How about that, guys? All right, so Season 2 begins, and the title of tonight, No, Globalists. There are actually several sections within this program tonight where I talk about what I believe is the globalist infiltration of the U.S. economy, which is one of the biggest threats we have as investors, and that's my job to be looking out for you. If you're new to the program, be sure on YouTube to subscribe to us. Also, click the little bell so that you get updates when we go live. Be sure to follow me on Twitter. I tweet every day, sometimes multiple times. We're also on Facebook and LinkedIn. Okay? So to try to clarify things, every week I'm going to present in 3 main topic areas: COVID, U.S. policy, and the world economy. Now, you've seen these topics before, but I'm just trying to be as clear as I can be about them. So let's start with COVID. And there's several things on the agenda tonight. So the report of blood clots over in Europe with AstraZeneca. Now, that's the European vaccination. has caused some countries just to stop using it. Germany, France, Sweden, Spain have temporarily, and I emphasize temporarily because you often wonder how temporary anything is when it's run by a government. Basically, because of a small number of cases of blood clotting, so 6/10,000 of 1% is enough to shut down the implementation of this. Now, why does this matter to us? Because this could create further drain on the 3 and perhaps 4 vaccines that we have here, and that obviously could affect our economy and investments. So Novavax is now definitely in the running for a 4th vaccine. Okay, they're addressing the original virus and its variants. We actually own Novavax in CG. Its stock price has gotten a strong bump since the last time I saw you on Thursday night last week, and we're excited about that. So what does this look like? The U.S. is administering quite a few vaccinations, a lot of them, and I'm trying to make the graphs this season really simple and really clear. We've gotten to the point of 2.4 million doses a day, and it's been a pretty steady progression, and that's a great thing to see if you believe that you want to be vaccinated. And I realize that that's not a universal belief, okay? And interestingly enough, other countries around the world, Israel, the UAE, the United Kingdom, United States, we're 4th in that line as far as who is getting vaccinated or the number of people. So again, that's an interest to you. And the reason I'm trying to really condense the information to exactly what is necessary. I think this is important because as more and more people get vaccinated, obviously it creates a sense of normality and gets the world back to where it was in February 2020 before this pandemic basically just took over. So what I want to focus on now for the rest of this COVID segment is a tale of 2 states. So Florida and California are those 2 states, the 1st and 3rd largest population states in America. Florida was one of the earliest to resume person-to-person instruction for kids, for children, I should say, in school. Last August, they returned to that. Basically, there was an executive order from their education commissioner that said if you don't reopen the schools, you're going to not have your funding from the state of Florida. Okay, obviously, took a different tact in California. And I think that the surprise here is that you'll see really there's hardly much difference. And in fact, Florida is better off than California. Just look at the simple scope of the data there as far as new cases over the last couple months. We'll also look at hospitalizations. Now, notice that the graph is different. So we have a 600,000 peak for California and about 350 for Florida. Why is this so important? Because Florida seems to have avoided these major outbreaks. Okay, and with 80% of their students in school, I think Florida is a better example of how to handle this. Today, we know that the solely COVID, now that's a new phrase that I hadn't heard until just this week. Solely COVID means who's dying from COVID, that solely that's the reason, there's no comorbidities there. But that sole COVID death rate worldwide is 0.26%. Far below the initial predictions by the globalist institutions and governments. And so I believe it's now pretty widely proven that the lockdowns really were not that effective. I'm trying to just bring you the clarity on this. You may not agree with me, but that's what I'm seeing based on now a year of data and following this pandemic. The California and Florida governors' very different approach seems to have yielded different results. Governor Ron DeSantis, and we have viewers in Florida and we have viewers in California. And basically, they reopened Disney in Florida in July, and now finally, Disney is going to be open at the end of April, or maybe it's April 1st in California. I just thought to myself, Bill Gates never warned us in the previous flu season or the previous, breakout in 2008 and 9. Why is he calling for all of this now? Why are so many people calling for these shutdowns? And why do we have 2 very large states in America that are having significantly different results economically? And I think it's because of the way they're handling this pandemic. So I understand this is a political issue, but what I'm really trying to focus on is the economic impact to you. Because where we can invest, where we have the ability to invest, is often reflected in what's going on in our individual states, okay? So let's just look at this. I think that it's pretty clear to see that Florida had the better outcome. I want to just cover again what I just said. And that's something I'm going to do this season, is repeat sections or repeat what I've covered to just, hopefully have it sink in a little bit better. So the AstraZeneca vaccines were temporarily halted, threatening the Asian recovery. The reason for this is because Asia is counting on AstraZeneca more than they are counting on U.S. vaccines. The second point is that Novavax may soon produce the fourth U.S. vaccine. Guys, that's astounding. 4 U.S. companies could have vaccines by mid-April. Third point was U.S. vaccinations ramping up and not down as they are in Europe, which is why our economy is more on track for recovery. U.S. administering 2.5 or 4 million doses a day. And then the worldwide death rate of COVID, 0.26, and again, that's far below the initial predictions by the globalist institutions and governments. That's why I named this episode, No, Globalists. Shutdowns appear to be, to me, like they may not have been necessary at all, or certainly not as necessary as many of the state governments thought they were. All right, so second section here, U.S. policy. Remember, 3 sections, COVID, U.S. policy, and the world economy. So where are we with U.S. policy? All right, I want to just start by saying I'm using this graphic because we are a divided country. You can even see the letters are half red and half blue. But I try to do this in a way that reflects policy and not politics. Politics is who gets what, when and how, but much is determined by many factors every day, everywhere. Politics is not the same as policy. Policy is what's actually decided, okay? What the government actually decides to do. Governments make the rules for living. We don't like to think about this, but it's true. Governments make the rules for living, working, and for how we pay for things. Those decisions are called policies, okay? We've just had a massive $1.9 trillion relief package passed with one party support. I'm sure you guys know that. I wasn't at all surprised, candidly. It was right on party lines by the narrowest of margins because that's how our Congress is divided. So will this bloated package really help Americans the way that it's been marketed to us? Well, I'm going to let you decide for yourself on this, and then we'll talk about it a little bit. But I think President Biden is pretty certain that it was the right decision.
I believe this is, and most people I think do as well, this historic legislation is about rebuilding the backbone of this country and giving people in this nation, working people, middle-class folks, people who built the country, a fighting chance. That's what the essence of it is.
Congress has now passed, and President Biden has signed that big $1.9 trillion coronavirus relief and stimulus package that they have been wrestling with since the beginning of the Biden presidency. This is a big moment, big for the country and big for Washington, for 2 reasons. First, because of what's in the package itself, and second, because of what it says about the still new Biden presidency. Let's look at those 2 factors in turn. First, the legislation itself. This is a giant legislative package. It's more than twice the size of the COVID relief bill that Congress passed late last year, and nearly the same size as the big CARES package that Congress passed and President Trump signed last spring in the early stages of the coronavirus pandemic. It's big enough, in fact, that it would amount to almost 40% of the total federal budget in an ordinary year. But it's not just the size of the legislation, it's the way it extends into every aspect of American life. It provides $1,400 in stimulus checks for many Americans. It provides $300 a week in supplemental federal unemployment benefits for the jobless, $350 billion for state and local governments, $130 billion for K-12 schools to help them cope with coronavirus expenses. It provides almost $9 billion to state and local governments for vaccination distribution and another $20 billion to help in the development of further vaccines. It increases the child tax credit from $2,000 to $3,600 for kids to the age of 6 and $3,000 to the age of 17. It also provides an additional tax credit for child care expenses. And it provides additional money for subsidies to help people buy health insurance policies on the Obamacare health insurance exchanges. Now, Democrats are thrilled with the scope of this package. They think it not only will help fight the coronavirus, but makes progress in social and economic areas that they consider important. But that's also why it has gotten no Republican support in Congress. Republicans think it's too big and too expensive at a time when the economy shows some signs of beginning to recover from the coronavirus slump. And Republicans worry that it extends government power into too many areas of American life in a lasting and a permanent way. Which leads to the second reason this is a big deal, what it says about the new Biden presidency. Passage means that President Biden has already, in his first 2 months, gotten a signature achievement on the area that is clearly his top priority, which is fighting the coronavirus. Democrats hope that progress in moving the country beyond the virus will translate into broader public support for the president and make it easier to pass more initiatives down the line.
The yeas are 50, the nays are 49. The bill as amended is passed.
But success also comes with risks and at a price. Is the package too big? Will the spending needed here crowd out money for other initiatives down the line? Will the fact that so much money is being poured into the economy set off a damaging round of new inflation? And does the fact that this passed with no Republican support bode ill for a president who has said it is important for him to create a greater spirit of bipartisanship and unity in Washington? In some, passage of this bill marks a big moment in Washington, but also the beginning of a period of new uncertainty.
Well, that gives you something to think about and maybe talk about. I see questions in the chat. Most of them are stocks related, so I'm going to handle those when we get to the stock section, guys. But in U.S. policy, again, we're not talking about politics. We're talking about policy, and this is now law. Okay? I don't know about you, but we actually got our checks, or actually automatic deposit, from this relief package. Maybe you guys have too. But I just want to talk tonight as far as policy goes. There's the real economy and then there's the financial economy, and they're intertwined, but they are different. So one of the major issues we have to face as Americans is, if we're going to be trying to pay off this debt, how are we going to do it? Well, the easiest and most efficient way is not necessarily the best. It's printing and devaluing money. That's the easiest way to get out of a debt crisis. Now, you might say, well, let's see, I borrowed $1 million, I pay back $1 million, everything should be fine. Well, unless the $1 million isn't worth what it was. Let me give you an example. When I was in high school, I baked a fabulous set of cookies for my girlfriend at the time. And she said, well, I'll pay you back. And so, I don't know, a few days later, I went over to her house and she hadn't done anything, but she reached up in the cabinet and said, here's a bag of Oreos. Let's just call this even. Well, to me, there was a lot more effort put into mine. So, cookies for cookies, that's not exactly fungible. Word of the day, fungible, being able to swap something of equal value. And that's what's going on here. If we're paying back debt with less money, the people that loaned us the money aren't going to be too happy about it. And that's part of the problem here. And this can result in shocking tax increases, because what has to happen? Well, more revenue has to come in to fund this debt. And actually prohibitions against capital movements, meaning that governments, remember in the opening slide there, governments have the ability, the opening slide for this section, have the ability to regulate cash flow and determine what we can and can't do. That's part of this no globalist theme that I've got tonight. I'm concerned about that for this country, and I can take the politics out of it and just say I'm concerned about it for us as investors. What you're seeing is this talk of how we're going to have these shocking increases because of the massive amount of capital that's been put into our system. You may not know this, but there have been 750 currencies that have existed since 1700, and only about 20% remain. That means 80% of every currency has been wiped out, and it's been wiped out because it doesn't have value. Okay, it does not have value, and that's what happens to a currency that gets wiped out. We're so used to saying that, well, we know that, our money in our pocket's good. Well, it's only good if it's worth something. In 1865, there were quite a few states in the south part of the United States that realized pretty uncomfortably that their currency wasn't worth anything. And there was a huge adjustment to life with that. So what would you have done if you had investments in a currency that just went away? Is this an issue for us? It absolutely is an issue. Is it something we have to worry about tomorrow? No, but it's on my radar. Because when we took our survey a month ago, you guys, 86% of you said, we want to know how you buy and sell stocks and how you make the decision for our portfolio and to keep us as risk adverse, you're never going to be risk free, as you can. Well, investigating the risks is one of the things that you guys pay me to do as your portfolio manager and that you get for free as your educator, those of you that are watching tonight in that capacity. So, okay, let's go forward here. And so just to review this, for U.S. and other nations, massive printing and thus devaluing of money is the easiest way to get out of debt. If you hadn't thought of it in that way, that's one of the reasons why the falling dollar is a concern, okay? This printing of money can result in shocking tax increases. I mentioned this a little bit ago, and prohibitions against capital movement. That's something people don't like to think about, but the government literally can decide what you can and can't do with assets, and I'll get to this in the next section. Okay, of the roughly 750 currencies that have existed, only about 20% remain. Those that remain have been devalued. Every one of them, certainly the US dollar is in that. And the United States could become perceived as a place that is inhospitable to capitalism and capitalists. Ray Dalio is the hedge fund manager for Bridgestone. He is one of the largest, I think he is the largest in America. So when he talks, we have to listen. The risks are more in a macro sense for us as investors than they are in any one particular company, okay? So the third category is the world economy, all right? And again, I've covered a lot of these topics, but just never organized them this way. And I'm hoping it's going to be better for you to see. And the world economy is really kind of complex. So I've broken this world economy down into 6 what I call sub-segments. So we have 3 segments every week and 6 sub-segments, okay? And the weekly market review is how we start. So the Russell up 18.3. Now, this is as of the close of the market yesterday. And yes, I do know the market pulled back today. Dow Jones almost 8%, S&P 5, NASDAQ 4.9, right at 5. The takeaway here is the Russell is continuing to lead. And the additional takeaway, as I've been telling you guys, is I'm just not concerned about that. We need to see all asset classes growing, okay? And it's just really important that you understand that the NASDAQ, which is where a lot of our investments are, may not always be leading like it was last year. I mean, it produced, what, a 62% return in CG and 63.5% in SG. We're doing pretty well this year, but we're not turning in those numbers yet. Obviously, we're not even through 1/4 of the year. So let's see how this looks, though, going forward. So I want to pause here just for a moment with our philosophy, basically to say that we evaluate the 11 sectors and industry groups. We select leading stocks from those. We invest with very few exceptions. We keep a pretty rigid plan there. We want to participate in the momentum and invest where Wall Street is bidding higher. And thus, we and our clients share in that wealth creation. So let me go back to the columns here and see what I have. Okay. Hey, Greg, good to see you. And Tommy, so broad question, how do you know when to sell a stock? It is a great question. And I don't mean to be flippant here, but you want to sell it after you see that it's going down and not coming back. And there's an art to that. There is no mathematical formula. I wish there were. If there were, candidly, Goldman Sachs and the other humongous financial institutions would control all the markets. But as we all know from GameStop, the small player can still do quite well because there is an art to all of this. But that's essentially the answer there. Hopefully before tanks, Nelly. Yeah, that was pretty good. So let's see, what do we have here? What 2 people are in the split flag? Bob Hope and Dolly Madison. It could be. I think they're both patriots. That's my opinion anyway, but good catch on that. So higher cost tech stocks selling off. Do you see any lower tech companies with room for growth? I've got 2 of them tonight in the section. You'll see that coming up, Tom. Thanks for asking on that. Thanks, Doc, for liking the video there. And Ford Motor Company declined to move forward with their new plant. Yeah, I'm disappointed. I did see that, and moving to Mexico, we'll see if that really has an effect on public perception. But certainly, in the previous administration, there was a huge nationalistic move to get companies to invest here. So let's go forward now and look at the performance from this last week. We show this for you guys that are new. This is CG. This is capital growth. I did want to address a question here. I had a user send me basically a list of questions. Can you just let me know when you see a company that has, battery supplies? I'm looking for, whatever Bezos is putting his money into. Can you, in other words, make stock recommendations or stock, clips, I guess, best of, so to speak. I don't invest like that. I'm not a trader. I'm an investor. I also get paid to do this for clients. And it's not that I don't want to give free tips. It's that I really have what's called a fiduciary responsibility to our clients. So I can't just make one-off recommendations because somebody might take that and decide to put 20% of their net worth in it. And if they're not a client and I don't know them, it could really be a problem for me, and it could actually be a problem for the person that's asking for that. There's really no great way to be an investor without a lot of hard work. Now, obviously, you can pay somebody like me or anybody else that's in doing what I'm doing to manage your portfolio, but that's the answer on that. So CG is our basic growth program, about 5% on the year. I've got these charts now full screen. The blue line is CG, so you can see it's been really volatile compared to the regular market, the main market there. We're a little bit underperforming in CG, but in SG, we are just killing the market. It's really been a strong year. And I had a second question about, this is someone that texted me and said, hi, Charlie, I'm looking over my portfolio in SG. I'm noticing that Fluent is continuing to be underperforming. I think it's down 27%. Do you see this swinging back? Just curious. Honestly, I don't know whether it will or not, but I responded to this client. Fluent was trading above its 250 and 20-day moving average. It dropped below it the day that I got the text from this client. The strategy in SG, so that you guys know, is that I trade only 4 times a year in that. I'm looking for the very best stocks that I can find, and I trade 4 times a year. So had that stock been in CG, I might well have sold it. But that's not the strategy in SG. Again, we're looking for multiple strategies to hedge our risk, okay? That's the point. GI and DG also have different strategies. This is DG on the year, which is diversified growth. This allows me to invest in ETFs in different sectors and different countries. We're invested in emerging markets in Germany and Japan, which we don't do too much in CG and SG. And then GI is our conservative program, but look at here. I mean, it's just had a really strong year, at least since the low in March there. And some of that is because of 2 stellar stocks, which I'm now going to mention. Okay, so here's the takeaway, guys. The NASDAQ is up more than 115% since the low of the trade war. It's doubled since the pandemic low, which was March 23rd of last year. And I just continue to believe that we are in a secular bull market. It's really important. You're going to hear me say this all the time on this program. A secular bull market means multiple cyclical business cycles, and I believe it's here to stay, okay? And so I'm investing accordingly, and I could be wrong, but I have a lot of evidence on my side to support this, okay? So the featured stocks, actually I always have one, but tonight I'm going to have 2. Viacom, which is in GI, a little different graph here so you guys can see, those of you that are clients that are in the various portfolios. We bought it at 65.34 as of yesterday. It was trading at 94, so our open position is about 44% gain. I like the stock just because, I think it's going to be a smart merger between CBS and Viacom. It basically got a bright outlook. There's all kinds of people watching TV now because they're used to staying at home. And they've avoided that trap of traditional pay TV, which is overpriced sports rights. I mean, that's what the networks are having to deal with, and certainly ESPN, just crushing blow. But I think that it's going to continue to do well. The little chart on the right shows what it's done since the pandemic low. And then the second winner in here is Williams-Sonoma, which just had a monstrous move. You see that big green bar there. We bought this at 91.54 as of yesterday, actually, end of the day yesterday, 165.81 per share. Open position gain of 81%. Why do I like this? Revenue up 25%. This is their most recent earnings report, okay? Their e-commerce portion of their revenue up 48%. Same store sales is good. Gross margin. They increased their dividend. That's why it's in GI, okay? So it's not even a growth play, but they, they've given us the advantage of having that. So, anyway, that's why we are in these stocks. So economic indicators, this is the next sub-segment. What do we have here? All right, so of interest to me is the 10-year yield. Now, I just want to explain again that people get concerned when they see that interest rates are rising. And the most common metric for that is the 10-year yield. That's the Treasury 10-year yield for the U.S. Treasury. Now, is it rising? Yes. Is it rising to dangerous levels? No. What's a dangerous level? Well, here's the deal. If you can get 15% in a bond, why would you even bother taking risk in stocks, especially if that 15% bond is, guaranteed? We can only use that word guaranteed in the case of U.S. Treasuries because they've never defaulted. All right. You probably would have hardly anything in stocks if you could get a guaranteed 15%. Well, nobody gets a guaranteed 15%. In fact, right now, as you can see on the graph, it's about 1.64. Okay, but let me put this in a perspective. This is the range in yellow there where the 10-year yield has been since 2008. We're below that. There is no huge move up in yields right now. Again, it's recency bias. I keep using this phrase. When you hear things in the media and you get concerns that, oh dear, we got to be in bonds, we got to be in bonds. I handled a question 2 weeks ago on this. This is the truth, guys. The 10-year yield is just coming back to where it needs to be, frankly. And it'll probably end up around 3% before it levels off here. These economic indicators inform the decisions that I make to buy and sell for you guys. Debt as a share of GDP is rising. Here's the pandemic. You see the red line. It's going off the charts, guys. Is this an issue of concern? You bet it is. We've never seen debt like this, and it's because of these trillion-dollar packages that the government is issuing. We had one in Donald Trump's administration. We have one now with Biden, and there are going to be more. I think there's going to be another $3 to $4 trillion. That's my assessment, okay? Travel uptick. This is good news. It's kind of a strange squiggly line here, but this is from the TSA, Transportation Security Association, whatever it is. And they're basically saying we've got an uptick. I mean, it started in May last year. It's increasing this year, and now we're almost back to where we were in January of this year. I think we're going to see that. Administration is the word I'm looking for. Thank you. Somebody typed it in the chat box there. So positive news, another V-shape recovery here, the great lockdown recovery. Okay, that's the blue line. It may be jerking around a little bit, but it's still recovering much, much faster than the Great Recession of 2008. All right, I think that's positive. And small business job openings. Now, it's just amazing to me that these jobs are going unfilled. It's kind of hard to fathom this. But the reality is that if you look at the data, so in the latest unemployment report, U.S. employers had 7 million unfilled jobs at the end of January, according to the Labor Department last Friday, just after I did my program. That's up from December and continued this rising trend. So even if all these jobs were filled, there will still be a few less jobs than there were, obviously, before the pandemic began. But there are jobs now for people. The question is, can they get trained to do them? That's really what's in play, and that's really the concern that we have, okay? So for economic indicators, what did we learn tonight here? The NASDAQ has nearly doubled since this pandemic low. That low is now in the rearview mirror. That means we are not going to see that again in my lifetime. The market does not listen to me, but that's my prediction, folks. We have seen the low, March 23rd, 2020, which the anniversary is coming up in 5 days here. Okay, the 10-year note is still quite low by historic measurements. Do not let recency bias harm you. And by harm you, I mean harm your mental peace of mind. Debt compared to GDP is skyrocketing and worrisome for sure. I'm watching this every day, especially if we start to see more trillion-dollar incentive packages coming out from the Biden administration. Airline travel on a solid uptick. I like seeing that. That's great because that return to normalcy gives people confidence. The retail recovery continues to better what it was in 2008 and 9. Remember the V-shaped recovery that I just showed you? And then finally, employers still have many job posts that are not filled. They're wanting to fill the posts, but they can't find people to do it. The Fed. All right, here he is, Jay Powell. Good old Jay. All right, so last summer, the Fed committed to letting inflation run. And I think that was a good idea because 2% is a reasonable target. They were going to basically say, we'll let it run to 2.5%, 3% for a short period of time, and then we can clamp it down by policy. Now, basically, the Fed is saying we're not going to change interest rates, meaning increase them, until the data shows that we're on our way to exceeding this target. Why does this matter to us as investors? Because the Federal Reserve controls interest rate policy. Low interest rates are good for companies. If it's good for companies, it's good for us as investors because it means more companies are able to be more profitable because they're not having to pay higher amounts for the money that they're borrowing to expand their factories and make more widgets and increase sales offices, etc. Okay, basically, Chairman Powell has said, we don't want to jump the recovery and start raising rates too soon like they did in 2008. Oops, kind of dumped on Ben Bernanke there, but the Fed did get ahead of it early in 2008, and that was a mistake, in my opinion. So that's where things are with the Fed. Now, if we sum this up, again, we need to know about the Fed because they do create interest rate policy. Jerome Powell, who's the chairman here, basically holds his dovish line. Dovish means low rates are favorable. Hawkish means higher rates are favorable. But he's saying we're not going to touch rates at all through 2023. Folks, that's Christmas 2023. That's 2.5 years away. That is a bullish sign. And the policy statement basically revealed no changes to the Fed funds rate. It was a unanimous decision. So we have the entire Fed on board with this. No question that the stock market liked it yesterday. I realize we had a little bit of a correction today, but remember, folks, we are in March, okay? And March is a weak month, all right? Showed you that last week. Recency bias, okay? The Treasury market, stock market liked what Jay Powell had to say. Incredibly, the Fed will continue to increase its holdings of Treasuries by at least $120 billion a month. That is a boatload of buying by the Fed. That basically means they're pulling up dump trucks of money, printing money, okay, and diluting it, but they're still buying those treasuries and creating liquidity in the system. That's a great place. It's really nirvana for the stock market and for investors like us, okay? All right, let's keep going through the subsegments here. Housing market just continues to shine. Existing home sales, look at the edge of the graph there. It's now taken out the 2007 high, heading back to 2006. I think that's really strong. Obviously, low interest rates make it great. The median existing home price now has equaled 2005, and I expect that to be taken out the next time I show you this data. Here's the real problem. There's not enough houses. Okay, there's just simply not enough houses. And that's the reality. If you're trying to find a house right now, I have a child in Baltimore that said there were bidding wars there. Now, I know I have posited on this program that most of these bidding wars are in southern states, warmer states. I've even said red states, but folks, it's everywhere. It is a seller's market across the country. I had one client who lives in Illinois said, I just feel like selling my house and going into an apartment and waiting for the market to come back down 20% and then rebuying. Well, you could. You can take that strategy with houses, with stocks, with bonds, with any asset, but that presumes you know where the high is and you know when the correction has stopped. That gets back to Tommy's question about when to sell a stock. Well, when there's not going to be anybody else buying it, but that's a tough thing to know, okay? They're calculations, and I will spend some time on that in a future episode on how I come to that. So let's review the housing section here. Existing home sales basically powering this new sales record going back to 2006, and I do believe that trajectory is going to continue. The median home price set a lifetime high. This is aggregated by certain hot markets. So it's happening in certain hot markets, certainly Tennessee, here in Nashville, Phoenix, Austin, but it's happening all over the country, north, south, east, and west. And that's, again, positive. So housing, sorry to go too fast here, housing supplies in serious short supply. How long could this last? Again, it'll last until we run out of buyers. I wish I could give you a number on that. The crypto corner. So a lot going on with cryptos this week. Basically, people are wondering what is going to happen and why are cryptos rising? Well, what's at stake here is that governments everywhere are competing and cash is heating up and they're printing money for these relief packages. So when you print money, you dilute its value. Just like my beautiful homemade cookies were diluted when I got repaid with a bag of Oreos. When we lose value in our currency because it's being just printed and printed and printed, obviously scarcity becomes important. And this is where cryptocurrencies have an advantage. Cryptocurrencies were created to supplant, not supplement, to supplant, meaning replace traditional fiat currencies. Okay? So why is India banning crypto? Well, we come back to this no globalism that is my theme for tonight, because they want to control. They want to control the currency in their country, and they don't want competition. They're not alone in this. China, Pakistan, Russia, Bolivia, North Macedonia, and Morocco. Now, I'm just seeing a pattern there. You guys seeing the pattern? I'm not seeing a whole lot of democracies there. And that's because they want to control it. There are concerns that Bitcoin or other cryptos, because they're decentralized and basically controlled by individual owners, will make it more complicated for central banks to create their own digital currencies and control the currencies in their countries. Did you guys know this? I just learned this week. That from 1934 to 1974, okay, that's 40 years, you were prohibited from buying gold in America. So the U.S. government stepped in and took control and said, no, you can't buy gold. Now, they started relaxing this in 64, but it wasn't until 74, and Nixon removed gold as the standard versus the U.S. dollar. You couldn't trade it, couldn't do anything. You could own some jewelry, I suppose, but that's about it, okay? So what's going on in crypto is yet another company is stepping up here and saying, we want to make a difference in this market, and we're going to expand basically what we're offering. So the Visa CEO says we're trying to do two things. One is to enable the purchase of Bitcoin on Visa credentials. And two, we want to allow Bitcoin to be translated into a fiat currency. In other words, you can pay in Bitcoin, but then immediately convert to cash, and therefore immediately be able to be used at 70 million places around the world. Literally, in the time I've been doing this broadcast, there have been hundreds of thousands of transactions in cryptocurrency. It's pretty astounding. It really is. And I only see it growing. Sorry, I'm getting a little ahead of my slides here, guys. So let's just give you a perspective on this. Now, Apple, had they wanted to, could take their cash and invest in cryptocurrencies, could invest in Bitcoin. We've heard about Tesla doing that. What would happen if Apple took some of their cash and did that? So if they were to step in right now and put just 5% of its cash, a very small amount, that's almost $10 billion, into Bitcoin, it would buy up over 14% of the supply on all of the exchanges in the world. In other words, Coinbase, which is a pretty big exchange, their current book orders would just drive would drive the price to 100,000 a coin 18 times over. Why is this important? Well, if you're following cryptocurrencies, then you know that I talk about them because they have limited issuance. That's the takeaway for you. Limited issuance. There are only 21 million Bitcoins. Other coins also have finite issuance, meaning they can't make more of them. A fiat currency is something that's not backed by anything, and it can be duplicated at will by whom? By governments. But the way that Bitcoin and many other, not all, but many other cryptocurrencies were created is with limited issuance. So as things inflate and you can't print more Bitcoins, guess what happens? Bitcoin rises and other cryptocurrencies rise in value. That's what we're following for you guys. That's what we think is really, really important about this. So that covers these 6 subsegments, and very briefly now, I'm going to just talk about 2 new segments that I'm going to introduce over the next few weeks. And one is American energy. I touched on this last week. Basically, this is a concept called the American Energy Portfolio. And one of our viewers actually brought this to my attention, and I hadn't thought of it in this way, but we have 5 sources of energy here in America and in other countries, but we're plentiful in each of these. Fossil fuel, hydrofuel, which is water, wind fuel, solar fuel, and nuclear. Now, there have been no new nuclear plants built, but there are still nuclear innovations happening, and I'm going to be excited to tell you about that when we get to that a few weeks from now. And we're going to discuss how I look at these for investment opportunities. Okay? Next week, I'll start on fossil fuel, which is 80% of what we use here in America. Now, this is not a political statement. This is just a fact. Okay? Renewable energy has exceeded nuclear. Obviously, renewable energy a few years ago was 0 or 1 or 2%. Now it's 11, nuclear is 8. But the preponderance of the way that we power our homes and businesses are with fossil fuel. And we'll touch more on that next week. Now, this is a segment that's near and dear to my heart. So, investing in post-COVID America, because you guys asked how I make investing decisions. You would think that I might respond saying, well, we have to look at the company's balance sheet and their income statement and their earnings per share and how they're doing. And yeah, that's important. Or maybe we have to look at the economic indicators that I've shown you. How are retail sales doing? How's GDP? How's the employment picture? That's important, but not as important as how is the basic structure of our investing environment going? And that's what's in play when we talk about what's happening in this area. What happened here? All right, sorry guys, we lost the screen there for just a second. All right, so look at this image. We worked on this to try to come up with a way that I visualize how I see capitalism in America. So pretend this is in the 1500s, I suppose, and we have a small village here, and we have all of these different trades in the village. We have someone working on making pottery, a musician. We have someone who's making shoes for the horses, the blacksmith. We have a baker. We have farmers. We have the merchants that run the stores. We even have a doctor that takes care of people. And this village really exists just fine on its own. But the challenge that they have is what happens when somebody invades their village? Well, they're unprotected and everything that they've worked for gets destroyed. So they came up with the idea, let's hire some people to put together a protective structure for us so that we can go about our business. That's really what we need for government. We need them to protect us from outside invaders. Now, because we are isolated in the United States, we would like to think that we don't have any real risks because we have these oceans that separate us. And for centuries, that was the case. But we certainly learned on 9/11 that the enemy can also be within. And frankly, we have those risks right now in America because there is a constituency of Americans that would love to see capitalism destroyed. And that's just not something that I want. And it's not something that, again, from a purely investing point of view, is in our best interest. So what we're going to cover in this segment, and it's going to take us several months to do it, is how the U.S. Constitution protects America's market economy. Capitalism requires a market economy to set prices and distribute goods and services. Socialism and communism need a command economy. Now, command economy, that's just a nice way to say people that command on how things are going to be done. Oligarchies, tyrants. You can say it any way that you like, but the reality is that some person or a very small body of people is deciding how everything functions in society, and you either toe the line or you leave or you're thrown in prison or worse. All right? Socialism and communism have a very different structure on how they decide economic decisions. And again, much fewer number of people just making those decisions. So here are the 6 characteristics, and we're going to follow this over the next ensuing weeks as I describe how this works here. Private property, and that's just not just real estate, but how we own things. Freedom of choice. We have the freedom to live here, to live somewhere else, to get up and go, to turn this program off if you want, to get out and drive to Montana at 2 a.m. tonight. We have those freedoms that we should never take for granted. That's one of the reasons that America is so special. Motive of self-interest. We can make the decision to invest in what suits us best for our family. We can give away a portion of it. We can decide to, feed the hungry with it. We can do really anything we want because we have that freedom. Competition. Other companies, if they see someone making a good product or a good service, can jump in, and we are benefiting by that as Americans by having so much competition. Now, some people say, well, the huge entities in this country, they don't have competition. Maybe the Amazons don't. Well, I don't know. Williams-Sonoma did a pretty good job here today. I'm glad to see it. I was thrilled to see that, not just for our investors, but because I don't want Amazon to be the only online success story. Walmart's done a good job of that, but Williams-Sonoma kind of came out of nowhere. What it shows to me is that American capitalism, entrepreneurialism is adjusting to the post-COVID investing world. And that's really our theme for year 2, season 2 here. Okay, so systems of markets and prices. These are determined by the buyers and sellers. When prices go up, less people are able to buy or are willing to buy. When prices go down, more people buy. It's a simple strategy, but it works really well. And last, but certainly not least, limited government. The reason I use this moat example is because notice that in feudal times, and I'm not trying to say that these times right now we live in 500-600 years later are as simple as they were back then, but basically people created a society. It worked really well. They hired, that's why I've got the guy in the armor there and protecting his constituency. But we just basically wanted to be protected. We want to be left alone. And I still think that extension, even though 500 or 600 years later our lives are more complex, I still think that extension works best for capitalism. Certainly it works best for our investments because it's tough enough to do what I and others like me do without having government interference. So when you guys ask, what's my main concern about investing and what are the risks? The risks are more government encroachment than they are anything else. And I'm going to do my best over the next 3 to 4 months to really expand on this section so you guys understand it. Okay? So that's it. I'm going to pause here. I'm going to look in the chat box. This is all we covered tonight. COVID, U.S. policy, the world economy, and then the subsections under that, the weekly market review, our featured stock, we actually had 2 tonight. Economic indicators, the Fed, U.S. housing market, and the crypto corner. And then 2 new segments, American energy and investing in post-COVID America. I'm going to check the chat box, but if you guys have a question, now is the time. All right? We got about 5 minutes before we close out here. And I answered Tom Z. I answered your comment about Ford. Yeah, I'm a little more interested in GM than Ford right now. So if you're good at something, never do it for free. Love that line from the Joker. Yes, absolutely. Why the inflation fear? Because anytime an indicator moves quickly, it can get people rattled, and frankly, it gives it gives the media something to talk about. Okay, I don't have inflation fears. I got to tell you, I don't have inflation fears. I'm just looking at the number. 1.6% in the 10-year is nothing. Okay, the average return of the 10-year is between 5.5% and 6% over the last 50 years. We are nowhere near that. Nowhere near it. Okay. Yeah, Nellie, Atlanta, 30 scheduled showings. Just crazy. Doc, you said you knew that about gold. So we're looking at rare mineral mining. Not something I've pursued too much on, but I'll think about that. So anybody else? Any other questions here, guys? Okay, well, I think that is it. That is our program for Thursday, March 18th. Season 2 is now off to a roaring start. We have a lot to talk about this year. We've got a lot of really great things happening in America. We really do. We have challenges. We're going to address those. As I said at the beginning of the program in the video, what I really want to be is a weekly encouragement to you. And I also want to be a weekly source of answering financial questions. If you have questions that didn't get answered on this program, my email is cb3@cb3.com. And in case you didn't know what CB3 came from, now you do, based on the opening video. So it just means the world to me, but you guys keep logging on here and watching. I hope that you got something out of it tonight. Tell your friends, please. We would love to increase the viewership. We're excited about these, improvements basically in our graphics and the presentation of the material. I hope it's something that makes it easier to remember and to understand when you hear it. So tell your friends, tell your family. It is Thursday, March 18th. I'm Charles Brown, live from Nashville. We so appreciate you being here at CB3 Financial. We don't just manage your assets, we become one of them. From COVID, U.S. policy, and the world economy to clarity. To clarity. Oh gosh. Thanks so much, guys. We'll see you next time.